Interest rates fluctuate a lot more than people realize. I might see 3, 4, 5 different rate tables in one day. In the morning, you might wake up and a 6.5 is 0 points. And by the end of the day, 6.5 is 1 point or whatever. That's not something that's widely understood.
Mm-hmm. A lot of times buyers will bring dad. That's fine.
And we're dads, so we can say
we're
this.
dads. Dads are what we call deal killers in the industry. We're not saying your dad can't come to the inspection, but just understand that typically what is found in this house is going to be found in the next house when you buy that one too.
When you get to this point is when the stress starts.
Yeah.
People are starting to have to provide a lot of personal information. They're going through inspections and like, what does that mean? We haven't gotten there yet. Is the appraisal going to come back? You know, all these things. And this is where the stress begins.
Yeah. All right, folks, we're going to go a little bit of a different direction today because, I was thinking about what to record, and, we work with buyers from time to time, and there's this path, right, that's going to create a stress-free home purchase and going to give people the right perspective. And so we wanted to share this, like if I'm an agent and I'm talking to a buyer, so a little bit of a different direction. So also, if you're a real estate agent, you can send this video to your buyer to help them sort of navigate their home purchase. And so this is just generally what I share with buyers as often as I have the opportunity. And it's never been more important than it is now because the market has shifted. And so there's a lot of confusion about how this process works. We also have a new generation of home buyers coming into the marketplace. And so, I thought it was like, let's do an episode that's a little more client focused. And that would be a help to our agents. And hey, for you agents, maybe you'll hear something that you haven't heard, or you find a phrase or a way to frame something that you haven't used before. So hopefully it'll be a benefit to you. Okay, so the first thing that I want to talk about, though, as we get into home buying, is that home buying is not a short game; it's a long game. And so many of the purchases that we make over the course of our lives are, we're making those purchases with sort of an immediate benefit to them, like if you're buying a microwave, if you're buying a refrigerator, whatever. And so when you're buying a home, though, it's a long-term investment strategy. And so we have to think about buying a home in 5 to 10-year segments. So in any 10-year period in history, house prices go up.
Yep.
Right? I think I learned that from you. Any 10-year period in history. And so sometimes people get caught up in sort of timing the market or trying to jump in at the exact right time to purchase a home. And really, you can't think about it in a snapshot like that. You have to take it from a 10-year period, and you can't see what's going to happen in the future. You can only look back and see what has happened over the past. And I've run into this a lot. People will always say, it's like, oh, well, this house was worth $250,000 when we bought it 15 years ago. I can't believe it's gone up this much. And guess what? 10 years from now or 15 years from now, they're going to be saying the same thing about house prices now. And so when you are looking to purchase a home, you need to be thinking 5, 10 years down the road and not trying to time it perfectly for this, like, hey, when the interest rate hits this and when the house prices hits this or the market's going to tank and all that stuff. Timing the market is never really a good strategy.
I think we've talked about this before. It kind of works itself out on the back end too.
Sure.
So like if you might get more seller concessions right now or this or that, when you go on the buy side, it might help you out. But when you go to sell, maybe you don't get as many, but it works itself back out on the buy side. So it's like anytime you're worried about the market, if it's a seller's market or a buyer's market, you're going to see the opposite on the other side of the transaction.
Yeah. And you just can't go in it with a mindset. It's like, you're not a day trader.
Yeah.
Right. So you want to think of more long-term investment strategy first. But the second thing is just understanding the fluctuation of the market and that markets are local. And markets can get extremely local because if you look at, like, occasionally a market will get to a neighborhood.
School zones,
proximity. A proximity example would be like, hey, if I live in a neighborhood that's on a lake, waterfront property is its own market versus non-waterfront property, and those things are in the same neighborhood.
Yep.
And so understanding the specifics of each individual market when you're buying a home is really important. And so when you look and you can have this is why it's so important to have a real estate agent to help you understand the market, both from a macro perspective and from a micro perspective. First of all, like what's happening generally in the marketplace, and then what's happening in this potential neighborhood, and or in this neighborhood or this area or school zone. So it's important to understand that and understand that those markets are specific. So you can't take this sort of generalized approach to buying a home. And so you've got to evaluate that market, so where you want to buy a home, and understand it well. So I think, really a good time is like if you're 6 to 12 months out from buying a house, that's kind of when you really want to start looking and understanding comps and what things go for.
I personally don't think, and I've been buying and selling real estate since 2002. Just done a ton of transactions, and I personally never think that there's a bad time to buy.
Right.
Because again, I just said it, like if you're going to sell for $100,000 less than you want to, you're going to buy for $100,000 less than you could have. Like it's all going to work itself out, and the appreciation always makes up for those minute little details that are impacting the market and in the current time frame. So honestly, I think there's always a good time to find a piece of property that makes sense.
And that's a really good segue into our next topic, or our next line item, which is price versus affordability. Because as buyers, a lot of times a buyer can get really focused on price. So here's what buyers typically do: is they get in, they start looking at houses online on Zillow or something like that, and they do an online mortgage calculator, and then they find out, it's like, okay, well, this house price gives me this payment, and then they use that sort of very rudimentary approach to start shopping. And this is why it's so important to get a lender that can help you determine what price range you're going to be in and what payment you're going to be in, because really you shouldn't be as focused on price as you are focused on affordability, in terms of, hey, look, this particular property is going to go up in value. What's the payment going to be from a monthly perspective? And we get really tied up in price. But here's the interesting thing, and I may be jumping ahead of here, but the interesting thing is, like, we were so focused on the price of the home, but one of the things that we never talk about, for buyers never talk about or never think about, is how much money you're giving to the bank.
Yeah.
Right? You're basically taking 5% or 6% or whatever. That interest is front loaded. If you've ever seen an amortization schedule, most of those first years of payments are going towards interest, not the principal of the home. And so I always want to say, it's like, quit trying to beat the market, beat the bank. Make one extra payment a year, and that knocks off how much? It's like 7 years or something off of a mortgage.
So, I mean, here's the thing, like, every other industry is focused on payment. The car industry, and because it makes sense from a budgetary perspective. Yeah. Like, outside of qualification, a lot of times people can qualify for more than maybe they want to spend from a budgetary perspective. Yeah. Focus on what your budget will support. So if your budget supports a $3,000 a month mortgage, and you guys are still comfortable to do your saving, to, if gifting, if that's something you do, whatever else your budget's made up of, just the required things like food, everything else, then that's where you need to be focused, and let the lender tell you where that backs you in from a price perspective. Because you're right. A lot of times people are like, well, $600,000 seems like a lot. Well, maybe at this point in time, $600,000, purchase price is only $3,000 a month on the mortgage payment. Mm-hmm. Maybe tomorrow, when the rates go up or whatever, it's higher. But focus on your budget and what your budget will support, and let the rest work itself out.
Yeah, that'll shape your sort of. Actually, I think that's the best thing to do, is to go, all right, where's my budget at? Let me figure out what I can afford. Talk to the lender, find out what price range that gets me in, and then start looking there. I think that's the best thing to do.
I try to have those conversations a lot. Some people don't. It kind of shocks me how many people just don't have a budget, which is another issue. But, I try to have those conversations a lot. Like, they just want to know, how much can I afford? Like, how much? What's the largest purchase price that I can afford? Mm-hmm. And I just think that's the wrong way to look at it. I usually back that into, all right, tell me your monthly expenses now. How much are you spending for housing? How much do you feel like you could afford on a monthly basis and still cover everything else you need to cover? And when I get that number, I try to work towards that. And I might say, yeah, you could afford a little more than this from a qualification standpoint. But if this is where you want to be from a budget perspective, this is where I would stay.
Yeah, and you might find it's like, maybe it makes sense for me to take this, and you've talked about this before, to take this amount of money rather than put it in a down payment, but maybe pay off a credit card that's got a super high interest rate.
Yeah, that happens a lot too, where like you'll look and they have like $30,000 in credit card debt, which is not unheard of.
Sure.
I mean, and I'm not looking down on them, but if that credit card payment, at 20+% interest is like the credit card payment's like 12, 13, 14, 1,500 bucks a month, and you have like 60K to put down on a house, I would knock that out.
Yeah.
I would, save the 30, put the down payment on the house, put the other 30 towards the credit card that you've got this balance on, because you're paying so much interest on $30,000 of credit card debt, or 20,000 or whatever it is. Whereas, the house payment, the mortgage is at like 5, 6, 7%. You're paying, that's your interest you're paying versus like 20, 25% on a credit card.
And the other problem with like using that rudimentary online mortgage calculator in terms of calculating your payment, there are I've watched you, sort of work a deal or work, back into a payment kind of a situation. And so there's so many dials to turn and so many like little things here or there that you can do for a buyer to get them where they need to be. And so for buyers, that's why I'm like, don't get to the lender on the front end of this search process, and so that they can help you shape that and understand all the different variables that you've got going on with your budget and your finances, and so that they can help you get there.
Yeah.
Right. Because you can help. I've seen you help people get to the payment that they need to be.
Yeah. Whether it's a mixture of current liabilities plus the mortgage, or whether it's mortgage, in any number of ways. And like you said, infinite number of ways to work this dial. But a lot of times you're right. People say, well, I have $60,000, I'm putting that down on the mortgage, but I can only afford $3,000 because I've got this $2,000 credit card payment. And usually there's a way to we can finesse all that and make it, more palatable.
Yeah.
But yeah, you're right. It takes a holistic look at finances to even start, having that discussion.
Yeah, I completely agree. And just for the benefit of someone who's buying a home, just understanding interest rates and the fluctuation, can you just explain a little bit about how interest rates get set and how they work and move up and down?
Are you talking about like locking, or are you talking about?
No, not locking, or just interest rates in general. Like, as people, like, what is an interest rate, and then why does that affect home buying so much, and how does it move, and why does it move?
Yeah, I mean, honestly, interest rates fluctuate a lot more than people realize. So I might see, 3, 4, 5 different rate tables in one day. And sometimes they, especially now, they might be drastically different throughout the day. And, it's based on the market, the bond market and everything else. And so people don't understand that in the morning you might wake up and a 6.5 is 0 points. And by the end of the day, 6.5 is 1 point or whatever. And just people, that's not something that's widely understood. And banks are basically, or lenders rather, are basically hedging their bets against all of this. They're saying like, hey, if this is what people who are acquiring these mortgages on the back end are willing to pay, this is where we need to set our interest rates so we still make a little bit of money. And it's a very intricate financial game that it can largely affect how much home you can afford at any given moment. And it used to be where interest rates didn't fluctuate as often as they are right now because everybody's so sensitive. So if you guys have ever seen like news come out that like the Fed's going to do interest rate cuts, and that's the base rate where everything sets, there's additional interest on top of it. But whether or not that they do the interest rate cuts they said they were going to do affects the rates that come out that day, or if they're going to reduce the number of cuts that they said they were going to do, that might affect it. Or if there's positive news, they might drop. So all of these things can shape the picture on any given day or time.
Yeah, and I would just say, as a potential home buyer, if you're thinking about buying a home in the next 2 years, go ahead and get to the lender, because don't try to make these determinations on your own. And don't try to, what's the word I'm looking for? I mean, it's like you're looking at this stuff every day, all the time. And so it's like, let that lender help you either get ready to buy a home or understand some of those, specifics. But, you get into a lot of times where I find buyers are like shopping rates or shopping for the best deal or the best interest rate. And I don't find that that's really helpful, generally speaking. It's like, I just like to go with a trusted lender. And like you said, just help me kind of get where we need to get in terms of affordability. because those dials move all the time. And so sometimes what might look good from another lender perspective, there's costs on the back end, or there's fees on the back end, or there's points on the back end. And so it may cost you more money to get into that house to get that interest rate. Yep. So just get with a professional, trust a professional.
If I could say anything, we're talking about trying to create a stress-free home purchase. If I could say anything, it's just focus on your budget, what the monthly payment will look like, and don't worry about everything else, because everything else is better left to a professional.
Yeah.
It gets super complicated. Most of the time, if you do shop interest rates, somebody's provided a loan estimate without prepaids and escrows. Somebody's provided one with, and so it doesn't match up. And you're like, well, I'm going to go with the cheaper one, but all the fees aren't in there. All these interest rates are largely the same. Now, there might be some fees that certain lenders charge that other lenders don't, or brokers or whatever. But if you're in the hands of someone like and trust, they're looking out for your best interest, as they should, and that's where I would stay.
I agree. And the other thing, by the way, this would be a good time to first of all to like and subscribe to the Agent Bridge, but also to do a little commercial for Hessen Loans. So if you need a home loan, please reach out to RL Hessen. We'll put the information in the show notes.
Okay,
and we can get you set up. He's the best in the business. Okay, so yeah, get with a trusted lender and help them, let them help you shape all of that stuff. But it did remind me that we do need to talk about closing costs and what they are, because a lot of times there's confusion around that. So from a buyer perspective, if you want to know what closing costs are, because we're like, oh, well, you should split the closing cost, or the seller should pay your closing costs. Closing costs mostly is the money that you're using to get the loan. So you've got a down payment, right, which is anywhere from zero. Sometimes it can be zero. Sometimes it can be 3, 5, 10, 20%, depending on the product that you're getting. But the closing costs are the loan fees. So you've got origination fees, prepaids for taxes and insurance. So you're prepaying for an escrow account. So an escrow account has a balance of taxes and insurance, because that's going to get paid at the end of the year to both parties, both the taxes and the insurance. So all of that stuff kind of gets thrown into closing costs, and it's going to be somewhere between 4 to 6% of your home purchase.
A little less, but honestly, closing costs are really misunderstood. So a lot of people think those are the fees the lender or the broker or the bank is charging. Not necessarily true. They do make up a little bit of the fees. They get lumped in with closing costs, but you've got the prepaids and escrows like you just talked about. So you got which is property taxes and insurance. Then you got transfer taxes, which are charged by the municipality to transfer the property from one person to another. Then you got title expenses, which are charged by a title company, which has nothing to do with the lender, other than that there will be closing the loan at the title company. Then you do have your origination, which the broker, bank, or whomever does have control over. So only one aspect of closing costs really do the lenders or the banks have anything to say about. You've got origination. They might be able to do some wiggle room there to reduce origination fees, but everything else is ancillary, third parties charging this money to the borrower. So widely misunderstood.
Yeah.
Prepaid interest is another one too. So a lot of people don't realize that when you close a loan during the month affects how much closing costs you're going to pay. So if you close towards the end of the month, you've only got so when you make a mortgage payment, you're paying for the month prior. So if you close a loan in any point in the month of July, your first payment is September 1st. So you're making that September 1st payment for the month of August. And so the month of July, if you've closed in that month, the number of days until the last day of the month, you have to pay prepaid interest to cover those days, because you lived in that home and never made a mortgage payment. Right. So you are paying for it, even though you skip a payment.
Yeah.
But if you close earlier in the month, those number of days are going to be more, and the prepaid interest will be higher.
Yeah. And if you want more information on that lending process, we recorded a podcast 2 podcasts ago, understanding the lending process from start to finish. So you can go back and learn every little bitty thing about it, if you'd like. Okay, so we've kind of got the financial part figured out, and let's talk about narrowing your selection for buying a home. And again, we want to think long-term and resale, not think right now. So I'm always trying to get my clients to think about, hey, if I'm going to sell this thing in 3 years, where's it going to be? Where's the market going to be? Because, and I'm usually advising my clients, I'm like, hey, when you buy a home, it's going to be, you're typically going to live in it for 3 to 7 years, but you need to be at least making a 3-year decision. And so we need to look at what the market's going to look like in 3 years, and that's subjective, but more like what's the resale going to look like in 3 years? Is the general trend of the neighborhood going up in value, things like that.
And the only thing we can do there is look historically at home price appreciation in that particular area. It does fluctuate, even in a hyper local area, how much appreciation you see on a historical basis, and you almost have to nix COVID. Mm-hmm. So we saw 10 years of appreciation in 3 years,
right,
during COVID. But on a normal market, 5.5% appreciation around Franklin, for instance, is pretty good. Yeah. So you would think in 3 years, you'd see about 15% appreciation. Not always true. Mm-hmm. You got historically high interest rates right now, so it might slow down a little bit, but in general.
Yeah. One of the conversations I've been having with buyers a lot these days, because I find a lot of times with first-time home buyers, they're trying to buy their forever home, like they're for their first home. And I'm like, guys, look.
Never happened.
Yeah, you're not buying your forever home. You're getting your money in the market, and you're going to, you're benefiting from appreciation. And so you're building some net worth here. So, all of those decisions, sometimes we're making decisions like maybe, too long. It's like, this isn't your forever home. This is just buying something now, getting your money in the market, and then we can take that equity and buy something else later.
Yeah. And, you hear the argument sometimes like, well, my parents stayed in a home for 30 years. Well, they also never changed jobs.
Yeah.
So back then, people didn't change jobs. They got their gold watch at 20 years. They kept working. Then they had their pension. They retired. People change jobs every 2 to 3 years now. So guess what? Usually you're going to have to change where you live, unless you just move, to the same, area or whatever. But a lot of times when you change jobs these days, you need to move to support the different job locations. So a lot of things are different than they were, in the 70s and 80s.
Yeah. And the other thing to just sort of keep in mind is, as you begin your search, you're probably not going to finish or buy a home where you thought, right? In terms of like neighborhood, price point, all of those things. Usually what we find is like with home buyers is they kind of have a general idea of where they're starting, and then we sort of end up over here, right? And that could be more, that could be less, that could be this neighborhood, that neighborhood. It's just an education process. And so you're gathering information on the way to eventually make that decision.
Yeah. Okay. I mean, you're just becoming wiser. You're doing a little bit more research. You're being educated a little bit more, and then you find something you weren't aware of by the end.
Yeah. Okay, so let's talk about offers and negotiations. So you finally selected a home, and it's time to kind of move forward. And there's a spectrum, when we're talking about what a home is worth, there's a spectrum, and depending on the condition of the home, depending on the days on market, seller motivation, the seller may have overpriced it. So there's a spectrum of negotiation. But I think a lot of times people's perspective when they're coming into this is that there are going to be big swings, or I'm going to get a great deal, or all of these things when they're coming into it. And typically you're going to get somewhere between a 0 to 3%, that's how much movement that you've got on the sale price of the home with closing costs, all of those things. So I would say, generally speaking, the most, like getting a great deal, quote unquote, would be like a 3% variable, right? In terms of the list price too. Yeah. Throwing in seller concessions and all that stuff. But just because it didn't vary 3% doesn't mean you're still not getting a great home. But I think a lot of people come in and they want to like lowball on houses, and it really is just generally not going to get you anywhere.
Yeah, unless it was just grossly mispriced in the first place. I mean, I think largely that 0 to 2, maybe 3% is where you're going to find yourself.
Yeah, so I just know that going in, and I get sometimes people want to come in and can swing for the fences, but more times than not, or I mean like 99% of the time, a buyer that comes in with that mentality of lowball and get the best deal possible, it takes them about 2 or 3 houses, and then they finally go, okay.
Yeah, and honestly, if you have a good real estate agent too, they should know, like, all right, this home is pretty well priced.
Yeah.
So here's where we need to start. So listen to them. If they're saying like it's priced well, don't come in 10% low, I would listen.
Yeah.
And you can create a lot of bad will in a deal by coming in with like a crazy low offer that doesn't make any sense.
For sure.
Like if you started off a negotiation process with anyone and anything, and the first thing they threw out was just like ridiculous, you're not going to take them seriously the rest of the time. So
yeah, there's this sort of like old conventional wisdom that, it's kind of like boomer. They're like, if they don't laugh at your first offer, it wasn't low enough.
yeah.
And I just don't find that that's the culture and market now. You want to come in pretty close to where you're going to buy.
Yeah. Now, I mean, if you had like your real estate agent had just a lot of information about why it was mispriced and you were going to come in with an offer that you felt like was going to be offensive to them, but you had a lot of information to back it up, completely different situation. Like, you help your real estate agent craft the offer and provide supporting documentation that showed why you were making a certain offer. I think that's different than just submitting a lowball offer. But again, that's why you have your agent call the other side of the transaction before you make an offer.
Right. But okay, and I said this before, but I want to come back to it. We get so caught up in, $2,000 here, $5,000 here, $10,000, whatever the case may be in this negotiation, when you're paying front-loaded interest at the bank over the course of 30 years. So again, make an extra payment a year and beat the bank. Don't worry so much about beating the seller. Beat the bank. They're the ones that are getting away with murder financially, right? In terms of how much that front-loaded interest is. It's like just make the principal payments and lower or get the principal paid down, and that's going to shorten the time of loan. And that's what one extra payment a year saves 7 years. That's 7 years of payments that will be saved by just making one extra payment.
And there's even a lot of lenders now that allow you to do recasts and stuff like that, which is great.
Yeah.
If you don't know what that is, it would basically be a lump sum payment to reduce your principal, and then they re-amortize the loan based on the new principal amount for you rather than having to refinance.
Yeah. Okay, so then we get to go to the under contract process, which is, hey, we've bought a home, we've negotiated, we've come to an agreement, and we begin the process, which typically is going to be inspections, appraisal, and loads of paperwork. Your lender's going to be requesting tons and tons of paperwork. You're going to need signatures from this party and that party and title companies and arrangements. So it can be relatively chaotic, but hopefully you've chosen an agent that's going to help you, make those or make that as smooth as possible. So you want an agent that is process oriented, and I would say that even has a team like a transaction coordinator and other people to help them get through that transaction and understand the process. Go ahead.
I would say until we've gotten to this point, it's all excitement. Yeah. And then when you get to this point, this point is when the stress starts.
Yeah.
I mean, agree. People are starting to have to provide a lot of personal information. They're going through inspections and like, what does that mean? We haven't gotten there yet. Is the appraisal going to come back? All these things. And this is where the stress begins.
Yeah. And also when we get to the end, so we're getting through all the paperwork portion, but the inspections begin. And you have to be ready for this inspector to go over the house with a fine-tooth comb and point out every little bitty thing that's wrong. Now, typically, we're going to see, as an agent, even on a house that's 2 or 3 or 4 years old, we're going to see a laundry list of items. Most of them are what we would sort of categorize as deferred maintenance. And then every once in a while, we're going to see a big issue like an air conditioner that's, not cooling correctly, or a roof that's not insurable or leaking, or some major plumbing problem, or water in the crawl space,
electrical
or something
issues,
that's Every once in a while, you're going to find those things. And what I would tell any buyer is I would say, well, first, learn how to differentiate deferred maintenance from a major issue, and don't major on the minors. You're going to find that in every single house, and those are things that typically a dad or handyman can come knock out. And that's really not what we're looking for. We're looking for the big things. And when it comes to the big things, those items typically will have to be repaired by the seller because they've now become a required disclosure if they were to go back on the market. They have to fix it and they have to tell people they fixed it. Or if they don't fix it, they have to disclose it. So it just becomes this required disclosure. So it's going to be fixed. So, and a lot of times that can be like super positive, like, okay, the air conditioner's bad. And sometimes a buyer's reaction would be like, well, I don't want the house then. It's like, just have them fix it. Now you get a new air conditioner
or a new refrigerator. Whatever. But
yeah, go ahead.
It's funny because the first time someone gets an inspection report, they think the entire house is falling down. They're like, I mean, there was like 36 items. Yeah, but a lot of them were, silly. So
yeah, and most of the time they are. So don't freak out about those things. Typically a handyman can come knock those out. And the other thing I'd recommend is if you are real stressed about potential repairs in the future, get a home warranty. We recommend Achosa home warranties, ACHOSA. We need to charge them for that.
$1 million.
I'm calling Emily. Hey, we plugged you on the
probably
podcast.
Just sold you 5,000 warranties.
So go to achosa.org, I think it is, and you get a home warranty for $775 that will cover most everything, and they're fantastic.
Super easy to deal with too.
Yeah.
We like them.
But the other thing is like a lot of times buyers will bring dad. That's fine.
And we're dads, so we can say
we're
this.
dads. Dads are what we call deal killers in the industry. If the dad comes to the inspection, I had a realtor ask me the other day, is like, are these the kind of buyers that are going to bring their dad to the inspection? I'm like, oh yeah, for sure.
I've had 3 deals killed by dad in the last 6 months.
What do you think why does that happen? What is it? The dad's like coming in to kill it's like a well-known.
He's the protector, right?
Yeah,
So
right.
usually it's a daughter, not always, but usually it's a daughter. He's very protective. He's under the assumption, and again, I'm a dad, I can say this. He's under the assumption that you can't trust anyone in this transaction. He's going to come take a look.
Yeah.
Spidey sense comes up, and he's like, "We're moving on." Like I wouldn't buy it.
It's just it's such a strange, situation. Now, I mean, we're more comfortable with it. Like if my daughter was buying a house now, I kind of know the deal, and I'm in the industry, but a lot of times these dads are just like, you're right. They don't trust anybody.
Yeah.
And they're like,
it's just protective. That you have to assume that, everybody's out to take advantage. And
right. I did have a dad recently that he was like, I was like, hey, how do you feel about the inspections? You look it over, and his daughter was buying the house. He goes, those inspectors. He's like, they're just, nitpicky and blah, blah, blah. So what had happened is he had his home inspected by a home inspector, and he's like, they called out like all of the stuff. And so his perspective was different, but we're not saying your dad can't come to the inspection, but just understand that typically what is found in this house is going to be found in the next house when you buy that one too.
I did have one dad, he was on the speakerphone when the daughter called me, and she was like, hey, are you going to be at the inspection tomorrow? I was like, my wife is. And she's like, okay, well, I just want to let you know my dad's going to be there. And he goes, I'm not coming to kill the deal. We're just going to dinner after. And I thought that was funny because he had heard that before.
Knows, yeah.
He's like, we're going to dinner after and I'm going to be there.
That is hilarious. I like that dad.
And he didn't. I don't think he gave any input, which was fine.
Anyway, so once we've got those repairs, we've got to sort of resolve, if there's anything big or if there's anything little. And what we like to do is usually employ a financial benefit to the buyer because, that seller is fixing things like they want to fix it as cheap as possible. And you as the buyer want to fix things like the right way. And so, we say is like, hey, look, let's just get a monetary credit that we can agree to if it calls for it. And then that monetary credit, you can apply that towards closing costs, or you can apply it towards, part of the loan costs, things like that.
Yeah.
Okay. So the appraisal, this is the other one. By the way, one more thing on the inspection. Inspection is not a pass fail. It is an evaluation. Okay. And an appraisal, when the appraiser comes, he's coming to verify the value of the home for the lending institution, for the bank and the mortgage company, whatever. So he's verifying the value. And so he's coming to pull properties that have sold in the last 6 to 12 months that match the value of the house that you're buying. And so 90% of the time, these appraisals come in like a right at value. It's not a problem. 10% of the time you're going to get, either it's going to come in, it could come in short. Sometimes it comes in higher. But if it comes in short, typically there's some sort of negotiation that would take place to figure out what's going to happen with that, with the gap between the appraisal and the purchase price.
Yeah.
Now, what we saw in COVID is that people were paying cash over appraised value no matter what.
Yeah, and just not getting an appraisal because they were paying cash.
Right. And so we're starting to see now appraisals come in, sometimes the value is a little bit off or whatever.
Both.
But,
I would say often the last 3 appraisals I saw that I ordered came in high.
Oh,
It was interesting enough, it was the exact amount of the seller concessions. So they were saying without the seller concessions that it would have appraised at that value, basically.
interesting.
So I thought that was interesting. I do see some low, not nearly as often in our market,
Right.
but I do some loans in other states, and I would say it happens sometimes in those states.
Yeah. Okay. Then we go to the closing process, which is you're going to go to a title company, or you might do a remote online notary. Nowadays, I mean, we used to always go to the title company. I found a lot more flexibility, especially through COVID, because that fast forwarded people being able to close from home or online. So the technology sort of and laws reflected that, and banks started to be able to approve electronic signature. But typically it's going to happen at the title company, and there's going to be a lot of paperwork. And sometimes buyers will come in and
This might be another freak out moment.
yeah, another freak out moment. And they're like, oh, I need to there's a sense that is someone going to take advantage of me? Listen, I'll tell you, there's no chance that you're walking away without signing something and moving forward with the purchase of the home, right? Like everything that's there that they're asking you to sign is going to be mandatory for you to purchase the home.
Yep.
And there are not, nobody's trying to get you at the closing table with extra fees or anything like that. It's all pretty standard. You have a settlement statement that's sent out, 2 to 3 days before closing. So all of that stuff will have time for review. You can ask questions of your agent and of the other people that are involved in the transaction, lender, places, and things like that. But, I've had people, read line by line. If you do want to read line by line, do everyone a favor and request that paperwork a couple days before so you can review it on your own. So we don't all have to sit there and watch you read it super slowly. That may sound rude, but
this is why I like Rudy Title here in Nashville, because they do a good job of explaining what needs explaining in layman's terms,
yes,
and to move it along so that somebody isn't just reading line by line.
Mm-hmm.
And they've seen so many of these that they can explain every document if they need to.
Yeah, exactly right. We're going to charge you, Rudy, for that too.
Yep.
Okay, so and then when it comes to moving day, which is always going to be stressful. So I just prepare yourself for the stress of simultaneously signing loads and loads of paperwork, and it feels like you're signing your life away. And then also we've got to move that day. So you've got moving trucks. And so it's kind of just like everything is colliding on this one, on D-Day for you to move into the home. We recommend Wednesday or Thursday closings. Wednesday's better than Thursday, never Friday, because Friday there's too much money moving around and these things are done in batches, right? So wires and things like that are done in batches. And so a lot of times we can be waiting on funding. And we typically like to start these closings at the beginning of the day. So think of like Wednesday or Thursday morning as early as possible so that money gets where it needs to get.
I mean, in general, you do not want to find yourself caught on a Friday. Money doesn't arrive. They don't give keys. Everybody was scheduled to show up to move you to the new location. They can't because you don't have keys. And now you've lost an entire weekend moving, and you can't get keys until Monday.
That's right.
Nobody wants that.
No.
Close on Wednesday. It's less stressful for the title company. It's less stressful for the lender. It's less stressful for the borrower. It's less stressful for the seller.
Mm-hmm.
And this whole episode's about stress-free. Just close on Wednesday, maybe Thursday, never Friday, and you will be better off.
Yeah.
And yes, I understand that you're going to take off a couple extra days from work.
It's worth it.
I get it. It's worth it.
You're going to need them emotionally after that process.
The time that you try to close on Friday and it doesn't work out and you've lost a weekend, I can promise you it would have been worth those extra couple of days you were going to take off from work.
I mean, I've had people, same situation. They wanted to close on Friday and something wasn't quite worked out. And by the way, these moving trucks they're doing it by the job, right? So it's like they're trying to do 2 or 3 jobs on that Friday and their truck's full of your stuff and you can't move in the house. That's a problem.
Yeah.
And so I've had people like crying on the curb in front of the title company.
Yeah.
So never Friday.
Never Friday.
All right. So I wanted to, anything else on that?
No.
I wanted to wrap the episode because I was sitting with my neighbor the other night. And he said, Brandon, what would you tell someone like that wanted to buy a house in the next couple of years. And I would say, buy it now. Get some seller concessions, refinance when the rates come down, get the equity bump because when rates go down, prices go up, and make an extra payment a year. That's what I would tell them. And that's in this current market. This is 2024, which June of 2024. If it's a market where the interest rates are low, I'd say buy it now, make an extra payment a year. And to me, winning in real estate is not about timing. It's about or timing the market perfectly. It's about making good decisions financially over the long term, right? To build your net worth, not trying to make it all on one, in one transaction.
Yeah, I would answer that question. If someone was truly not buying right now, if the question was truly, I'm going to buy in a couple of years, what do I need to be working on? I would say talk to a lender, have them run your credit, try to get all of that in order.
Yeah.
Do not take out any extra debt between now and then unless you just absolutely have to, and minimize it if you do. And trust me when I say, if you can work that over the next couple of years from a credit perspective to have it in a good position later, it's going to pay off. I would not wait until the exact moment I was going to buy a house to make sure all of that was in order, because people take on additional debt that ends up ruining a credit file, or they miss a payment that ruins a credit file. I would get all of that in order well ahead.
And the other thing that I would say is when it comes to creating the most stress-free, and this is going to sound, like a salesman, I guess, but I honestly believe this. The best thing that you can do to create a stress-free transaction is to get a great realtor, get a great lender, because those two people together will take so much of that stress off of you and handle so much for you that it'll make it go smoothly and easily. And trust them, right? Yeah. Trust them. Get a good realtor, get a good loan officer, and trust them. Guys, thank you so much. Hope you enjoyed the episode. Please make sure to like and subscribe. We'll see you next week.